Is this the best time to invest? Or is America secretly pulling a bait and switch on the world? While many see a falling dollar as a sign of weakness, it may actually be a sophisticated trap. Today, we're going to uncover what American capitalists are really trying to do, and why they seem to be ignoring elementary school math. Basic economics tells us that when a country's interest rates are high, its currency should be strong. But right now, the opposite is happening to the US dollar. What if this isn't a mistake? What if it's a deliberately engineered illusion? A financial smoke bomb designed to conceal a much larger, more shocking plan? What does this all mean? Wealth Topmax warmly welcomes you. This channel is dedicated to sharing wealth-building mindsets for those seeking financial and time freedom. If you don't want to miss out on future valuable insights, consider subscribing for free and turning on the notification bell. What on earth are American capitalists trying to do? And have they completely miscalculated elementary school math? Let's break it down with a simple example. Suppose today you have $1 million in hand. Currently, a US bank can offer you an interest rate of nearly 5%, while a European bank can only give you about 2%. So, which bank would you choose to deposit that $1 million into? The choice is incredibly simple. You would choose the US because each year you can receive $50,000 in interest, while in Europe, you would only get $20,000. You would make an extra $30,000 risk-free. This means you don't have to do anything. Just by depositing your money in a US bank, you can lie back, and after 1 year, you'll have an extra $30,000 to spend. After 10 years, that's an extra $300,000. So, what ordinary person wouldn't choose the US bank? In other words, under normal economic conditions, as long as the US interest rate is significantly higher than Europe's, rational people will exchange the euros in their hands for US dollars and deposit them in US banks to earn that higher interest. This creates demand for the dollar. So, when people sell euros to exchange for US dollars, the euro should depreciate, and the US dollar should appreciate. Currently, the US interest rate is nearly double that of Europe's. At the same time, Europe has continuously signaled a dovish stance, while the US has remained hawkish. Logically, the US dollar should have appreciated strongly against the euro, right? But what has been the result? Not only did the dollar not appreciate against the euro, but it has also depreciated significantly, losing up to 12% this year alone. This strange phenomenon implies that even though US interest rates are higher, the world would still rather accept the meager $20,000 in interest from Europe than take the guaranteed $50,000 in interest from the US. Why on earth would this be the case? The simple answer is that global investors must perceive the risks in the US as being more frightening than the 3% profit margin they are giving up. There are two common explanations for this. First, they might believe that US banks are no longer safe and could collapse at any time, as we saw with the regional banking crisis. So, it's better to earn no profit than to risk losing your principal. Second, they might feel that the US dollar itself is no longer a safe haven. For example, even the richest capitalists in America, like Warren Buffett and Ray Dalio, and major corporations like Goldman Sachs and Morgan Stanley, are all publicly warning that the dollar is going to hell. If the titans of American finance are themselves selling off and fleeing from the US dollar, then of course, a logical person would also exchange their dollars for euros to avoid risk. Regardless of the specific reason, the surface-level conclusion appears to be the same. The United States is no longer stable and is about to plummet, which is why money is supposedly fleeing from the US. But is that really the case? You would find it very strange if money were truly withdrawing from the US en masse. So why, after the stock market crash last year, could US stocks still stage such a powerful recovery? This means that it seems the US dollar has not actually withdrawn from the stock market. What about real estate in the US? It hasn't collapsed either. So if the money isn't leaving stocks or real estate, there is only one possibility left. The US dollar has withdrawn specifically from the US bond market. And if you look at the charts, the US bond ETF has dropped another 10% this year. Therefore, Many people online have concluded that U.S. bonds are no longer stable. Everyone is worried that America's debt is growing too large and it won't be able to pay, so they are moving their money to the perceived safety of Europe. But here is where the story starts to break down. If U.S. dollars were withdrawn from U.S. bonds to go to Europe, that money should have been invested in European bonds. U.S. bonds are considered safe, risk-free assets. If a fund manager is selling one safe asset, they will typically move that money into another country's safe asset. So, if you sell U.S. bonds, you should be buying safe European bonds, like German, French, or British government bonds. But if you look at the data, whether it's German, French, or British bonds, none of them have appreciated in price. In fact, no one is buying them in significant quantities. This means it's not because European bonds are more attractive than U.S. bonds that money is flowing there. Instead, you will discover that the French, German, and even the British stock markets, since January when the U.S. dollar began to depreciate, have all set new highs. So, has the money withdrawn from safe U.S. bonds actually flowed into the risky European stock market? In other words, does the world now feel that high-risk assets in Europe are safer than low-risk assets in the U.S.? Could it be that these sophisticated capitalists believe that since the Russia-Ukraine war broke out, Europe, which no longer has cheap gas and oil, and no longer has cheap labor, can somehow have an economy that will surpass the U.S.? That doesn't seem right either, because U.S. market performance and economic data are still better than Europe's. So what is the real truth? What if I told you that regardless of the interest rate games or the suggestive capital flows, all of these bizarre financial phenomena are just smoke bombs? What if their purpose is to create the illusion that the U.S. is in decline, thereby concealing the fact that the U.S. has been secretly pumping money into its system and has found a new blood-sucking machine? Let's first address the depreciation of the U.S. dollar. Is it truly a sign that U.S. money has moved to Europe, or even to Japan and Taiwan? On the surface, of course. For the dollar to depreciate, people have to be selling it. But the real question is, how much money does it actually take to make the dollar depreciate by 10%? It's very simple. Look at this past May. In just 2 days, Taiwan's actions caused the US dollar to depreciate by 10% against its currency, and it only cost less than $8 billion to do so. Now, consider this. Life insurance companies in Taiwan alone hold about $600 billion in U.S. assets. If the value of these assets decreases by 10% due to the exchange rate drop, they stand to lose $60 billion. So, if these Taiwanese life insurance companies don't want to lose that $60 billion, what should they do? They will not sell. They will hold on and wait for the exchange rate to rise again. This is a brilliant trap. By spending just $8 billion, the U.S. can create an exchange rate environment that effectively traps $600 billion of Taiwanese assets within its borders. The same situation applies to Europe. In April, about $30 billion flowed into Europe, causing the dollar to depreciate by 10% against the euro. But Europe holds over $1.6 trillion in U.S. bonds alone. By spending just $30 billion, you can effectively lock up trillions of dollars of European assets in the U.S. So, is the depreciation of the U.S. dollar really a sign of massive capital outflow? What is the truth? The truth is that yes, U.S. dollars are flowing out of the U.S., but the amount is actually not very large. The U.S. only needs to spend a little money to cause the dollar to fall sharply, thereby preventing Europe and Asia from selling off the dollar-denominated assets they hold. It's a strategy of using a little money to tie up a lot more money. But one point can be confirmed. Although the U.S. dollar is not being sold off massively, there are also no large inflows of foreign capital continuing to buy U.S. assets. Otherwise, how could the dollar depreciate? So if foreign money isn't flowing in, where does the money come from to help the U.S. stock market recover and rally? You are about to see the strangest financial phenomenon appear. This chart is the U.S. money supply. Simply put, it shows how much money is in the U.S. market. If this blue line goes up, it means the money in the market is increasing. If it goes down, it means the money is decreasing. In 2022, the U.S. Federal Reserve began to shrink its balance sheet, which means the Fed was actively withdrawing money from the market. As expected, the blue line in 2022 went down. But if you look at 2023, after some major banks in the U.S. collapsed, this blue line started to turn back up. Most importantly, this blue line has continued to rise until now. This means that even though the Fed is still shrinking its balance sheet and raising interest rates, which should be sucking money out of the market, the amount of money in the U.S. market is actually increasing. This completely contradicts the common belief that the U.S. is short on money. Why? It's very simple. Because Wall Street is dramatically increasing its financial leverage. For example, Morgan Stanley recently raised its leverage ratio from 9 times to 11 times. Goldman Sachs also went from 10 times to 13 times. What does this mean? Increasing leverage, simply put, means they are borrowing more money. Today, if you take $1 million to buy a $1 million house, your leverage ratio is 0. But if you take $1 million to buy a $10 million house, you have to borrow $9 million from the bank. Your leverage ratio is 9 times. So, for example, although Goldman Sachs may have only earned an extra $30 billion because they increased their leverage ratio, they could borrow up to an additional $600 billion. In other words, the reason why the amount of money within the U.S. is continuously increasing is because Wall Street's financial institutions have been continuously increasing their leverage ratios, borrowing more and more money to increase the amount of capital in their hands. So the question arises, what are they borrowing so much money for? Currently, interest rates in the U.S. are incredibly high. Why would they borrow so much? Because they have found a casino with a rate of return higher than that interest rate, and that is the U.S. stock market. So here is the real story. When the U.S. dollar depreciates, it traps foreign capital. While that capital is trapped, the money supply inside the U.S. secretly increases because Wall Street is increasing its leverage. And when the U.S. stock market recovers, it doesn't require a very large trading volume because there are very few sellers. Wall Street is borrowing at high interest rates to pour money into the U.S. stock market, confident that they can push prices up because no one else can afford to sell. But why do U.S. bond prices continue to fall? Because the world's central banks have found a new reserve asset, gold. For years, countries like China would take the dollars they earned and buy U.S. bonds. Now, when those bonds mature, they are not reinvesting. Instead, they are taking the dollars and exchanging them for physical gold, which they then transport back to their own country. As more and more countries do the same, accumulating gold instead of bonds, the price of gold will naturally rise, and the price of U.S. bonds will naturally fall. The decline in U.S. bonds is not because the number of sellers has increased, but because the number of large sovereign buyers has dramatically decreased. So, to fill the gap of these missing bond buyers, Wall Street's primary bond dealers are forced to step in and buy. If they don't have enough money, they have to borrow money to buy. And that is another reason why the capitalists of Wall Street are increasing their leverage ratios to support the U.S. bond market. But if they're borrowing at 5% to buy bonds that also yield 5%, there's no profit in that. So where does the real money come from? For decades, the U.S. has had a secret blood bag, Japan. The Bank of Japan would print money, lend it to American capitalists at near zero interest, and that money would flow into U.S. assets. But now, Japan is raising interest rates. Not only has it stopped transfusing blood to the U.S., but it's also starting to suck money back. So what does the U.S. do? It finds a new blood bag, Switzerland. Recently, Switzerland has lowered its interest rates to be even lower than Japan's. The number of U.S. financial companies borrowing Swiss francs has now surpassed the number borrowing yen. Switzerland is replacing Japan as America's new blood bag. Many people don't know that Switzerland manages up to 1/4 of the world's total private wealth. The world's super-rich deposit their money in Swiss banks for safety. When the U.S. is short on money, American capitalists can borrow from Switzerland at a nearly zero interest rate. They are using the money of the world's super-rich to give themselves a blood transfusion. So let's put all the pieces together. Since 2023, U.S. policy has been a masterclass in financial manipulation. First, it uses a strategically depreciating dollar to trap trillions in foreign capital within its borders, preventing a mass sell-off of U.S. assets. Second, while foreign capital is trapped, it uses a backdoor, increased financial leverage on Wall Street, to secretly pump hundreds of billions of new dollars into its own stock market, creating a recovery that seems to defy logic. And third, to fund all of this, it has cultivated a new source of cheap money, a new blood bag in Switzerland, replacing its old one in Japan. This is a grand, high-stakes game. For investors, this means the current market is not driven by traditional fundamentals, but by these massive, engineered capital flows. This explains why astute investors like Warren Buffett are holding cash and diversifying, waiting until the market has finished this period of artificial inflation and a clear, sustainable trend emerges. Whether the next move is a sharp collapse or a continued rise, it does not affect a patient investor's plan because at that time, we can use the money earned from other markets to reinvest in the U.S. The key is to understand the game being played and not be fooled by the smoke bombs. Thank you for joining us here at Wealth Topmax. We hope this has given you a valuable new perspective on the global financial landscape. Don't forget to subscribe for notifications, and we will see you in the next video.